Hello, everybody, and welcome to this latest weekly market recap. This is for the week ending Friday, September 13th. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it's certainly a pleasure to be with you again this weekend. A lot going on in the market. We had a couple of big inflation reports last week. Both the August CPI and PPI reports came out on Wednesday and Thursday, respectively. The Wednesday CPI report was as expected on the headline number, but was actually a little bit higher than expected on the core number. Market was expecting a rise of 0.2%. We actually rose 0.3%. And then on Thursday morning, we got the exact same thing. We had the August PPI report released, and the headline number came in as expected, but the core number was just slightly above, rising 0.3% instead of the 0.2 expected. So we had that last week. So now we're set. We're set for the Fed to meet this week. They'll be meeting on Tuesday and Wednesday. Wednesday at 2 p.m. will be their latest policy decision and their statement of what they see, what they expect, what they're planning to do, how they're approaching this new phase. It was just a few weeks ago that we saw from Jackson Hole, Wyoming, Fed Chief Powell talk about that the Fed is now ready to change its policy to adjust its policy. And so that to me means no more hikes. It means no more leaving rates higher for longer. It means a rate cut is coming this week. The question that a lot of folks are asking, is it going to be 25 basis points? Will it be 50? Everybody's got their own opinion. Personally, I think we're going to see a 25 basis point cut. I don't think that the Fed wants to send a shock to the market, which is exactly what they would do. I think if they lowered it by 50 basis points or more, I think that they're going to say, okay, our job's done. We believe our job's done on inflation. And they'll probably throw some kind of a caveat out there, so long as the data, doesn't change drastically. We believe that inflation is now in check, something along those lines. And they're going to now be focused more on the economy, more on jobs. And that means lower interest rates. Now, things aren't going to change overnight as far as rate cuts, especially if this is going to be a series of slow cuts. That'll be another thing I'm sure that Fed Chief Powell will talk about. Are we going to have a series of 25 basis point cuts? Is that what they're expecting? How long will this go on? Do they think they're going to do it throughout 2025? Is it let's just do a couple and see how everything's going? I think the wording is going to play a role in this as well. So anyway, we got a big upcoming week because of that. Also, options expiration. Now, we did have a nice recovery last week. I'm sure there were a ton of in-the-money put options that were in play, but a lot of those may have gotten wiped out from last week's movement. We, of course, do our regular max pain events on the Tuesday before Friday options expire. This month, we're actually moving it up to Monday. Because I'm going to be on vacation starting Wednesday of this week, and I will be out of the country actually from Wednesday to Monday. So there will be no weekly market recap next week. I do want to make sure everyone is aware of that. So no market weekly recap next weekend. I'm sorry, but I will be back the following weekend, just to let everyone know. Anyhow, but we've got the Fed meeting, we've got options expiring, and then we've got this second half of September that I'm going to talk a little bit about and show you some numbers. But this can be a very, very difficult period for the market from a calendar perspective. And like I said, I'll talk about those numbers in a bit. It's not a slam dunk guarantee, but I'm talking about tendencies, historical tendencies that are fairly strong. And you need to be aware of those. So anyway, let's go ahead and jump in because we got a lot to go over. I'm going to start off, as I always do, kind of taking a big picture view, if you want to call it that, of the 6 major indices that I like to follow. So the Dow Jones, the S&P, the Nasdaq 100, the Russell 2000, mid caps, and then also the transports. Those are 6 key areas, and then the 11 major indices. So what you're going to see on this particular summary of the chart list are those 11 sectors along with the 6 major indexes. So we've got 17 different groups here. And I've got them on a 1-week period, how they performed, and it's in order of performance. So if you look at the top, technology, hallelujah. This is, I mean, this is the biggest part of the S&P 500. If you want the S&P 500 to go higher, it's generally going to occur with technology, especially big moves in the S&P 500. The way you get big moves is by having the big areas of the S&P 500 making big moves. So technology did a lot of good things last week, and we'll go over that chart in just a little bit. But there's still some things we need to be a little cautious about here as we try and get through the September-October period. If you go all the way down to the bottom, you'll see there's one group out of the 17 that was negative last week. Only one group, energy. And again, we'll look at that chart. We'll look at crude oil prices, and I think you'll be able to see the correlation there and why energy struggled. One group, though, down here that I was a little surprised is that financials. Financials have been a really good performer over the last month or so, maybe 2 months, on a relative basis and on an absolute basis. But we do go through periods of profit taking. That's what I'm going to chalk that up to. Last week, I do think financials will do well on a relative basis throughout the balance of the year, but last week was definitely not their week. Anyhow, you can kind of go through it. It just seemed like more growth, more aggressive areas of the market rebounded last week. And some of the defensive groups, areas that had been performing really well of late, kind of took a little bit of a backseat, and we'll see what the next week holds. If the market rolls over and turns back down, I think you might see the leadership flipped again, because generally during pullbacks or moves to the downside, we see more defensive areas, more dividend payers that tend to do a little bit better because they're not as reliant on growth. That's going to be the big theme, I think, of the next 4 to 6 weeks, is talk about a possible recession. So watch the economic reports that come out very closely. Personally, I don't think the economy is going to get that weak. I'm not ruling out a very, very mild recession over the course of the next 6 months. But a lot of times what the market will do is price it in before it happens. And so that's why I think these next 4 to 6 weeks are going to be important, because it's a period of time historically when the market doesn't do that well, especially second half of September, which again, I'll show you some numbers in just a bit. So when you start putting a lot of these different pieces together, that's what helps me kind of shape what, how I think the market might move over the next few weeks, even into 2025. So over the next few months as well. But let's keep moving. Got a lot to go over. Here's the S&P 500. So the S&P 500, this is a 5-year weekly chart. So it's big picture. Still got negative divergences we're dealing with. So yes, last week was great. We bounced off the 20-week moving average. Normally, I would say, awesome, let's go. New highs coming. I think we just got to stand back and try to keep perspective in play, know where we are on the calendar. I want you to take a look at the numbers I've provided you here. The S&P 500 annualized return since 1950. We're going back 75 years. This isn't what happened the last year, the last 2 years. It's not happened this isn't what just happened since the pandemic. We're talking about this goes back 75 years. This is a lot of data. Look at how September breaks down. So September 1st to the 16th, just bring it in here so you can see it really clearly. September 1st to the 16th, the S&P 500's annualized return for this period is positive 8.14%. Had a nice rally last week, but it does fall in this period. I think now, as I was looking at technology, I think technology is almost essentially flat for the month of September, because we had a great week last week, gaining 8%, but we previously had gone down by roughly the same amount. So right now it's just flat, and we're in the first half of September. Look at the second half of September, starting on the 17th. When is the 17th? 17th coincides with the start of the Fed meeting, 17th and 18th. So it could be, that we're having this nice rally going into the Fed meeting. Maybe the Fed says some good stuff and we see a sell-off. Or maybe, it wouldn't be out of character for the Fed maybe to say something that, you weren't quite expecting. They may not guarantee we're going to cut anymore. They might just say, hey, we're going to cut here, and then we're going to just look, step back and kind of continue to watch data. We saw inflation a little higher than we wanted to see last month. They could say anything. All it takes is a few words by Fed Chief Powell for the market to absolutely, I'm not going to say collapse, but you know what happens with the market when just something gets a little bit taken out of context. Market can sell off pretty rapidly. So I'm not saying it's going to happen, but hey, these are facts. I'm not coming up with this. This isn't my opinion. This is how the S&P 500 is traded for 75 years. We already know that we are about to go into a hornet's nest starting on the 17th, which is Tuesday. The real part of this September 17th to 30th period, that is the worst part of the period, is actually later in the week when we get to Friday options expiration. And from there, from the 20th to the 26th, look at the annualized return on the S&P 500. Now, again, that's annualized. This is just 1 week. So it's probably just under 1% that it averages going down. So you think about that and you say, well, S&P 500, 5,600, 1%, that's 56 points. Who cares? Well, just keep in mind, that's the average. Most average, if we look at just about any other period of the year and you look at an average over 75 years, it's going to be positive because the market goes up more than it goes down. Here we're saying the average over 75 years is going down about 1%. That doesn't mean it goes down 1% every year. Some years are a lot worse than others. So just keep in mind, 17th to the 30th is a struggle, and especially the 20th to the 26th. And by the way, just if you know anything, if you follow our work and our historical work, you know that every month, the 19th to the 25th is the weakest part of the month, of all months. So and there are a couple of exceptions. December with the Santa Claus rally, normally leading up to the Christmas holidays, it's more bullish than bearish. So there are exceptions out there, but the general rule is that the 19th to the 25th is weak. And here we're pointing out the worst week of September is 20th to the 26th. And this is also the second worst week of the year, trailing only a week that comes in about 4 weeks in October. And we'll be talking about that more as we get closer to that. But anyway, those numbers are not good. Let's move on and look at the Nasdaq. So the Nasdaq still got a negative divergence, although technically the open a week ago went down almost right to that 50-week moving average. So it's a little unclear. It's a little cloudy as far as taking a look at divergences. Is it still a negative divergence? Is it not? Hard to say. What I can say is that we've been losing this 20-day moving average now, or 20-week moving average. We did it back in October of last year. But other than that, we hadn't done it until back in April when we were weak. And then at the start of August, right after the last Fed meeting, we were heading down into it. And then absolutely collapsed. Again, collapsed, that's a loose term, relative to what we had been doing. That was a pretty big drop from the middle part of July to that early part of August. Anyway, we bounced off of that. Now we went back down below that 20-week moving average again. Now we're back up above it, kind of starting to feel like it's a trendless market. That, we're kind of going up, then we go down, then we go up, then we go down, not really breaking out, but not really breaking down. So we're just kind of in this middle of nowheresville right now. So how does the Nasdaq do in September? Well, here are the same dates. 1st to the 16th, up 6% on an annualized return basis. 17th to the 30th, minus 31.65%. And the 20th to the 26th, minus 52%. So not much better here. How about small caps? Russell 2000, which is tracked by the IWM. Since 1987, that's when the Russell 2000 began. Russell 2000 annualized return, September 1st to the 16th, plus 25.61%. Pretty good return through the first half of September. And, looking at the chart, we came down, we rallied back. So far, I would say it's been kind of a probably less than normal September for small caps. But we did get that big rally last week, especially on Friday. We had a big day on the small caps on Friday relative to both the Nasdaq and the S&P 500. But when we moved to September 17th to 30th period, minus 39.73%, almost 40% annualized return. And for this 1 week, the 20th to the 26th, minus 83.88%. That is the definition of a really bad week, historically. So we've got all this essentially to look forward to in the second half of September. That's what I'm telling you. Today is September 14th. Of course, Monday will be the 16th. Where is this going to go in the second half of September? I don't know. I can't tell you for sure. I've got no guarantees for you. But one thing I can tell you is that, and this is a fact, not my opinion, second half of September has not been kind to stocks. So we'll see what happens this in 2024 during this period. Volatility index. So when I look at the volatility index, I see a couple things. First of all, whenever we're spiking on the VIX, that's generally not a good thing for the stock market. And if you look at a seasonality calendar on the VIX, you'll know that its worst periods are August, September. I think October is not great either because we have had some big drops in those months. So when we have a big drop in the market, it usually, well, it will coincide with a massive increase in the VIX on a percentage basis. And so when you go back and you average, let's say over the last 20 years, and you average the VIX, well, even if it turns out to be a decent VIX, the VIX might go from 14 to 13 during the month, or maybe to 12 if it's a good month. So what are we talking about in terms of a percentage drop? Maybe 10%, maybe, when we have a good market. But the majority of the time we have a bad market in September. And I've seen months in September where we've gone from the teens up into the 30s. What's the average? Let's say you go from 15 to 30 in a month of September. That's a 100% increase. So when you look at the VIX, it'll probably be up maybe about half the time in September, maybe even less than half. But the average of what happens is generally a pretty high number on the VIX, because when it goes up, it can go up a lot. When it goes down, it's going to tend to not go down too much. So the average of those percentages is going to show that August and September can be really, really bad months. Good months for the VIX, but that means bad months for the market. As I look at the VIX right now, what I do see is still an uptrend in place. Usually when you're in a period of weakness, you will see the VIX remain in an uptrend. And when that uptrend breaks, that tends to be a signal that the things are getting better. Fear is dissipating. And as a result, the stock market tends to go higher. So I'll just show you a couple of these. Like, look back to 2022 when we ultimately, let me see, the VIX had moved up. Yeah, you can kind of see this trend. Let me zero in here for you. So the VIX was trending up as we went in and we marked our final low on the S&P 500, which was right here. Remember, we hit the bottom. It was the open on, I believe it was October 13th, 2022. I think that was the final thing. And then we took off in the market. Well, took off is a relative term. Nasdaq, S&P 500 actually did better than the Nasdaq. I think the Nasdaq was pretty close in December to where we were in October. But from that point on, the market really did very well. And so if you look at this, that trend line right there, when it broke, which was probably in the second half of October, the bottom was in. I don't know. Here we had kind of a rough start to 2022 in the cyclical bear market. And that was during the first leg down. VIX came back down, and that was when we had that big push toward the end of March. That was the first key bear market rally. To me, it was a head fake out. We were calling for much more at the beginning of 2022. And so I didn't trust that rally. And we ended up going back down. We started a new VIX uptrend and so forth. But these uptrends, when they end, tend to coincide with market bottoms when the market starts to turn higher again. So here was September to November of 2023. So right here, remember we had the correction in 2023. So from September to the very beginning of, well, actually latter part of October, we were going up in a nice uptrend and the market was going down. We broke that uptrend on the VIX at the beginning of November. Look what happened to the market. So when we broke this uptrend, we had not broken out yet. We were just coming back up to the most recent high. A lot of folks thought we were going to go back down. We were already on the bullish bandwagon by that point. That breakout or breakdown in the VIX led us to a massive rally and more all-time highs. So what I'm going to be watching here over the next 4 to 6 weeks is for a similar development. where we see the VIX trending higher. So we've gone up a lot on the VIX. We got up to 65, which is crazy. One of the highest readings we've ever seen with that August 5th gap down and low that we saw in the markets. But it came back down, but it did come back down and stop at a higher low. We did the same thing. We had a rally here into the end of August. And when we did, the VIX came down, but it came down to about where it was before, maybe just a little higher. So again, there was still some fear in the market. We went back up on this latest drop at the beginning of September. And now as we rally back up, we've seen the VIX pull back, but we're higher than we were at the last two. So the S&P is getting pretty close to the all-time highs. These highs are pretty close. But notice for each of the highs, the VIX is higher than it was. So we still got this uptrending VIX. And part of it, I believe, is just the market still fearful about what's to come in September and early October. And a lot of times, it's almost a self-fulfilling prophecy, I believe. The market starts to anticipate weakness in August and September because it happens so often. And as a result, as long as this fear, even the lows, when the VIX is coming down, if we're still printing higher lows, then we haven't necessarily ended the potential for another big spike in the VIX and another big sell-off in the market. Now, if the market keeps going up and sets a new high and we see that VIX back down into the lower 14s, this might not be your typical September. That's what that signal would be telling me anyway. Now, if we're going up and defensive groups are leading it and technology is not participating, then we'd have another signal telling us. My point is there are a lot of signals going into the market. None of these are primary. These are all secondary indicators. The only primary indicator is what is the S&P 500 doing? Is it breaking out to an all-time high? Well, guess what? You can't be bearish when stocks are at an all-time high. So at that point, you've got to hand it to the bulls until proven otherwise. I'm still suspicious. I don't think we break out. We're getting close. I mean, we're only about 1% on the S&P 500 from being at a new high, all-time high, which is, being cautious in the month of September. That's an eye-opener. But we'll see whether or not we get through, like I said, Fed meeting, options expiration, second half of September, especially 20th to the 26th. How is all this going to play out? Is it going to be different than history? And we're just going to take off? It's possible. But I think the more likely scenario is to kind of be careful, and especially if we start rolling over again on the S&P. All right, let's take a look at technology. So here's the move in technology, but we ended, if I pull up the inspector button here, we ended August on the XLK, which is the ETF that tracks technology, at $220.33, $220.33. Where did we finish Friday? $220.44, 11 cents up. So it feels like after you've had a big week that, hey, market's rolling. In the month of September, it really isn't rolling. It's actually just getting back to where we were at the end of August. And if we do like we normally do, we'll see another rollover in the technology group. And watch for that. We go back through these moving averages to the downside. That would be a signal that, hey, we're not trending to the upside. If we're trending to the upside, a pullback should hold the moving averages, and then we should go up. If we go back down even just below 215 on a close, to me, that's a signal we're going lower again, or at least a warning sign that you better be prepared for possibly going lower again. I do like the fact that the AD line, look at the AD line ready to break out. I mean, technology prices relative to where we were a couple months ago, we're still down $16, $17. That's 8% off the high from July. And yet the AD line moving up to new all-time highs. So I do believe that there is accumulation, which is a good sign for once we get beyond this period. Like I've said, I think later into the fourth quarter, I believe we're going to be much stronger. And this would be an argument for that. The AD line goes up when you are doing better in the afternoon than you are in the morning. That's essentially, it's a sign of accumulation, hence the accumulation distribution name. But as we move back up, this has been a very, very strong period for accumulation, according to the AD line. So I like to see this. I like to see markets go through a period of hesitation or even a little bit of selling and see that AD line remain strong. So that's a positive right now for the XLK. All right, XLE, remember that was the worst performer last week. And you can see big down move. I talked about this on my Thursday show over at Stock Charts. And you can see we had that nice rebound on Thursday. And when I saw that, I said, this is an area where we could see a rebound in the XLE for a while. Now, you got the 20-day moving average coming in at 87.5. You got these lows coming in from about 86.5 to 87. So it's not like we don't have some overhead resistance that we have to watch. But what you also need to watch is crude oil price. And the crude oil prices have been coming down. Notice over the course of the last year, we went to a 52-week low when the XLE was cratering recently. But now crude oil prices are starting to bounce back up. So if crude oil prices can get back through key resistance, then I believe it stands to reason that the XLE has a pretty good chance to do it as well. So watch crude oil prices in the upcoming week. I didn't like the reversal on Friday, finishing back down near the low of the day, but it does now have a pattern of higher highs and higher lows. Can we get back through overhead resistance around $72 per barrel? And then the 20-day comes in at 71 and change. So I do think we still have a little bit of upside until we have a couple pretty big tests. But if they're successful tests, we get through them to the upside. I think energy could be poised for a rebound later in September, maybe into October. All right, S&P 500 is on the top of this chart. This goes back 25 years. The bottom of the chart is the Fed funds rate. And so when you look at this, you can see there have been some periods of some serious spikes. We just went through that in 2022 and 2023. And we did the same thing back in 2004 to 2006. And also you can see we were peaking as we turned the century back in year 2000. But there's an argument out on the street. And the argument is that if the Fed starts cutting the Fed funds rate, obviously this starts to roll over and go down. What has happened at these levels the last two times that we've seen this century? What has happened? Here we had a period where rates went up, rates stayed higher for longer, and we rolled over. And as we rolled over, the market topped. And we had one of the nastiest bear markets in our history. And you go back to 2000, and you had this period where we topped. And look what happens when we topped. The S&P 500 had one of its worst bear markets in history. And so now we're looking at this and we're saying the Fed's going to cut rates. So we're just starting to roll over. So there's a lot of folks in the camp that's saying, hey, batten down the hatches, get the heck out of the stock market because we're about to take a tumble. Personally, I'm going to call it recency bias because it's only happened twice in the last 25 years. And both times, I mean, if I told you, I'm a good golfer. So if I go out and I told you that I hit my last two drives out of bounds to the right, would you just assume that I'm normally somebody who hits the ball out of bounds to the right? I mean, it's a pretty small sample, isn't it? Just two holes. Maybe I just had a couple bad swings. I don't know, maybe the wind was blowing that way. I mean, there may be normally I hit the ball in play off the tee. Well, if we go beyond these 25 years, let's take a look at the next chart. This one goes back 50 years. So here was the move down in rates. Here was the move down in rates when short-term rates were being cut. You can see that was during the secular bear market. But what happened other times? I mean, let's go back to 1989. We took a big tumble in rates over the next 4 years. We had a little bit of a drop in 1990, but otherwise, I mean, do you see any massive bear markets? I don't. Market took it in stride and actually was moving higher. It was a great time to be in stocks. How about the biggest peak of all, 1981? I mean, we had a double top here at 19% on the Fed funds rate. And it was a very, very steep decline. I mean, we pulled back in 1981 into early 1982, but as we kept moving down, this kicked off one of the biggest bull markets in our history. So now all of a sudden the argument of what happened in 2000, 2007, I don't know if it holds water. I mean, yeah, the last two times, you're right. It's been rough. But that wasn't the case in prior, interest rate tops where we started to roll over. So what's the difference? And, what should we expect? Well, I'm just going to give you a little secret here. We're going to have an event coming up in a couple weeks, probably late September or early October, probably be early October. But I'm going to talk about this a little bit more in depth and give you reasons why I believe what I believe on the S&P 500. And that if you had only looked in the 1980s and 1990s, you would have said rate cuts were good for stocks. But if you only looked in this decade, 2000, 2010, you would have said, well, rate cuts are the kiss of death. I mean, for me, it's all about perspective. When we take a long-term perspective, now what do you think? Maybe we go higher, maybe we go lower. There's I don't think there's anything overwhelming that says that the market can't go up when rates are being cut. Nothing that really says the market can't go down while rates are being cut. It can go either way. But I got my thoughts on which way it's going. I'm going to talk about it in a couple weeks. So mark your calendars. And actually, if you're not already an Earnings Beats Digest subscriber, we'll obviously be announcing what we're going to be doing to our membership, but we'll also roll it out to the EB Digest community as well. So you can go over to earningsbeats.com. I'll even pull this chart up or pull the website up for you. So if you go over to earningsbeats.com, all you have to do is scroll down and you will find an area where you can subscribe to the free Earnings Beats Digest newsletter. It's a newsletter, comes out 2 mornings a week, Monday and Wednesday, talking about things that we believe are important in the market. It could be just something about the overall market picture, the big picture. Might be something like sentiment that we talk about, or it could be relative strength, or it could be individual stocks. Usually it's going to be an individual stock that we like for whatever reason, or we don't like. Maybe it's coming up on big resistance or a trend line and volume trends are weak and relative strength's horrible. And so we're looking for possibly a rolling over. So if you like to short, maybe that's a chart that would appeal to you. Sometimes we do charts where we're looking at it from a long perspective and we either just saw a big breakout, maybe some pullbacks, but this is how we pass it along. Just we're trying to give back, trying to educate the community. Some of you have been doing this for a long time. Maybe you don't get a whole lot out of this. Maybe you just find a snippet here or there that will help you. But again, it's free. We're trying to help, things I've learned over the years. So go to earningsbeats.com and sign up for free Earnings Beats Digest. First of all, no credit card required. You can literally unsubscribe anytime you want. No questions. We'll remove you. But most of the people, we've had tens of thousands of folks join us. Most of the people keep it because, again, it's free and there's a lot of value in this this newsletter. Anyhow, just wanted to pass all that along. Let's take a look at the Mag 7. So what I want to do is just go through these pretty quickly and just show you these on a little bit bigger scale, 5-year weekly chart rather than what's just been happening the last 2 months. You can see NVIDIA, great company, great stock, great chart, moving up from left to right. Yes, it is still subject to market weakness. We saw that with the 2022 cyclical bear market, where NVIDIA on a split adjusted basis, after the split, moved down from about 35 to 11, 2/3 of their market value because of a cyclical bear market, because growth stocks get absolutely trampled in a cyclical bear market. They're based on growth. They are being lifted up based on their huge growth that's expected. And when all of a sudden you run into a recession or just a downtrend or a slowdown in growth, the PE ratios are going to come down. You're going to get a repricing of these kinds of stocks. So I know everybody loves NVIDIA. I'm no different. I love NVIDIA. It's a great company. But you have to be able to look back, use perspective, and see when a company might be due for some extended consolidation or selling. And I'm just not sure that's not what's happening to NVIDIA right now. We went from 11 or 12 bucks up to 140 in a year and a half. That's unsustainable. If you think a company is going to be worth, any company that's gone up at that fast a rate, if you think it's just going to continue and be worth 10 times again over the next 18 months, I'm sorry to tell you, it is very, very unlikely to happen. I mean, to go from 140 and you're going to go up 10 more times, you think it's going to be 1,400 in a year and a half? I would bet against that. So right now we just need to consolidate. I think NVIDIA is growing into the market cap that essentially was assigned it by this huge run up in price. And so it's just going sideways. We got a negative divergence, which a lot of times will lead to a 50-week test or any kind of a 50-period test, whatever chart you're looking at. And so the recent low, beginning of August, was down close to 90. And right now, the 50-week moving average, which is still rapidly moving higher, is close to 84. So that range is not out of the question, especially if the September headwinds kick in and we do see the market roll over and things start to get more fearful. Maybe a couple economic reports come out, not very good. There could be a host of different things that could come out. But if the market starts thinking more about a recession, then all of a sudden, that's where all of the discussion goes. And as a result, we see more fear in the market and the market comes down and NVIDIA goes down with it. That's the bearish scenario that could develop here over the next month or two. Maybe it goes longer. I don't think so, but I would not be surprised for the next month or two to see a period of continuing weakness on semiconductors. So anyway, that's NVIDIA. I'm not going to spend this much time on all of them, but let me just go through Apple. Apple continues to go higher. Again, great company. Recent high was established up at about 238 or so. The recent low was down just below 200. I think we're in a range. Microsoft, same thing. High to low, we're in the middle. I think we've got our range established right now on Microsoft. Now, if we turn back down, let's say Microsoft can't hold 380. We got a neckline coming across here. There's a left shoulder. This could be a right shoulder. There's your head in between. This could be a head and shoulder pattern. And the reason I say that, a lot of people look at this and then automatically become bearish. Oh, I see a head and shoulders. Good luck with that, because in bull markets, a lot of times they don't execute. So I would not be overly bearish Microsoft until we saw a big volume breakdown below about 380. I don't know if that happens. Again, could we go back down and retest? Sure. And if we do, we're going to have the pessimists and the bears everywhere talking about bearish patterns. Maybe they break down, maybe they don't. I mean, we'll see. I need to see the breakdowns. Let's see. Next, let's take a look at Meta. Meta has actually been one of the better performers. Sideways consolidating for a while. The weekly PPO moving down closer and closer to the zero line. I actually think if Meta gets back down to 450, we'll probably see a center line test on the PPO. And we'd also be testing very, very solid price support down between 425, 450. That's right where the 50-day moving average is. And off of an uptrend with sideways consolidation, normally you tend to break in the direction of the prior trend, which in this case is higher. So I do like the way Meta is setting up, but I still think it's too early. We need to see this September period unfold and see what maybe it sets up for us. Next up, Amazon. Amazon, I think, also has been pretty strong. That last high, we do have a negative divergence. So we came back down. We did go to the 50-period moving average. PPO is now down near the center line, and we're starting to roll back up. This is one that I think possibly could break out. I like the setup because it has now tested that the negative divergence has played out. We're starting to rally back. I see some other stocks that are kind of similar in similar businesses like Walmart, even Costco. Not quite the same because of just how they're set up physically, physical locations and stuff like that. But they do compete in terms of products and so forth. Costco breaking out, Walmart breaking out. I think there's a chance Amazon, of all the seven, I would give Amazon probably the best chance to break out in the midst of what might not be a great market. Google may be one of the worst right now, but We did have a nice reversal on the 50. And so maybe all of the short-term weakness we've seen is over. Maybe Google will start getting some love here, but I would not want to go back down below this 146 to 150 area. Let me see, last one, 147.22 is the low. So I'd really like to see 147.22 to 150, that area hold on Google. Tesla, you can see Tesla maybe starting to turn back, breaking out of this short-term downtrend, but this is a wide range. Even if we just look at the recent high and low, and it is getting closer to the high end of the range, I just have to see a breakout on Tesla because it's been going sideways for a long time now. Probably still trying to grow into the market cap that was established when it had the huge run throughout the, prior to the pandemic, through the pandemic, and all the way into 2021 when it set its high. So I think a lot of this is just consolidation. Ultimately, I see Tesla breaking out and going a lot higher, but I would be sitting on my hands right now. Netflix, I like to talk about Netflix when we talk about these stocks. I think Netflix looks pretty good here too. Massive top, right at about 700. That's where we keep bumping up against it. It looks like we're going to get through and then we pull back. Looks like we're going to get through, then we pull back. I think if we get through, it's going to be a definitive breakout and you're not going to miss it. I think if you're watching Netflix every day, you're going to know when this one breaks out. Watch for increasing volume. Watch for a big hollow candle that not just goes above 700, but probably hits 725, maybe even 750. Then I think you're going to have something on your hands to the upside. But again, we haven't broken out. We do have negative divergences on Netflix. I'm going to throw out there a few stocks that I thought looked pretty interesting here just of late. So I'm going to go to a daily chart here. GE had a big up move back first half of the year. Has been going sideways for a while. False breakouts, sideways, false breakouts, sideways. Well, this past week, we just made the breakout. And we did it with weekly volume increasing to the highest level since probably back the early part of August. So or daily volume, I should say. So daily volume over the last 6 weeks, Friday was the highest, and it occurred with a breakout. So I like what happened on Friday with GE. A couple others that I'll just mention quickly. HD is been trending up. It just broke out above recent highs around 375. The big high coming up is about 390. And if we pull this one up on a weekly chart, you'll see that just above 390 or right around 390 at the end of 2021 was also a high, 2021, early 2022. So right before the cyclical bear market, that's where Home Depot got to. Then in right before April, right before we sold off in April, Home Depot finally got back up to that 2021 high. And now with last week's action, especially on Friday, we're back up to that 380 area. So Home Depot hasn't broken out, but this is a pretty significant area that we're approaching. So watch Home Depot. This would be another. And remember, the Dow Jones already broke out to a new high. We know the Dow Jones has been doing well. So when you look at these stocks, Home Depot being in the Dow, that's a lot of these stocks are doing this. These big companies are making these breakouts. So Home Depot would simply be the latest. So keep an eye on it. Zillow Group. I was looking at this, and this is a stock that really got beat up from 2021 to 2022. We rallied, but we've been struggling, really unable to get through 60. We closed at almost 58 on Friday. So again, if we go back to that daily chart, look at it from that perspective, you can see the big move up, the volume picked up, and getting pretty close to the high that we saw in December of 2023. So no breakout yet. So a little premature. I don't go getting in right at resistance. I would much rather get in right at support, which would mean maybe a pullback to the 20-day moving average. Maybe we go straight through this 58 level, but it's not just a 52-week high, as I showed you. We're talking about going back the last few years. That if we break out, that would be the 3 or 4 year high, which is pretty significant. So I'll keep an eye on that one. AXP, this is American Express. Been trending higher. This was a good stock in August, even when, maybe the market wasn't at its best. I mean, it took out July highs. S&P 500 couldn't do that. So we got a stock that's showing relative strength, and here it comes again, trying to make the breakout above about that 260 level. IBM, I just wanted to point out parabolic. I mean, it's starting to turn parabolic. For IBM, this is a really, really strong uptrend. If we go back and we look at like a weekly chart on IBM, check out the RSI, weekly RSI. It's hard to get IBM up to 80 on its weekly RSI, right? I mean, we saw it back at the beginning of 2024, had a pullback, and now here we come again. This is a stock that's looking a lot better. Here was the monthly chart, 2012 through 2022. Essentially, we were sideways. 2023, we made a long-term breakout, and we are continuing on that path. So IBM is doing something right. Wall Street likes this company. We probably should like it too. And then the last one I mentioned, Walmart. Just wanted to pull this one up quickly. But here's another one. This one goes back for a long time, and this has just been a great company. Only problem is, again, you're getting it at a very overbought level here. But if, big picture, if we were to see Walmart drop $10 or $15, which might not be happening now, but maybe it happens later in the year, next year, you get anything close to a 20-month moving average test, that would be great entry into Walmart. All right, that is it for me. Again, I want to remind everybody that I will be on vacation starting Wednesday of this week. So for members, that's going to mean John Hopkins will be doing the daily market report for Wednesday, Thursday, Friday, and also Monday. I'll probably do a weekly market report on Tuesday. So just to give you the big picture look on Tuesday, but I won't be around to do it on Monday. This show, not going to have this next week. I won't be able to. Some of the reports, chart lists are no big deal because strong earnings chart list, we really don't have many companies reporting right now. Actually, when this vacation was planned, it was planned with that in mind. That from a earnings beats perspective, it's actually a pretty slow period. It's the third month of every quarter, calendar quarter, tends to be a little bit slower for us, but especially the second half of the third month. So the latter half of March, latter half of June, latter half of September, latter half of December. These are times when, if I can, I try to work in my vacations because there's not a whole lot going on. But anyway, got that coming up. So just, probably won't have EB Digest we won't have an EB Digest on Monday. Just normal things. Portfolio report will probably be delayed till the following week. I'm just not going to be in a position. I probably will take a computer with me. So I might do some of those things, but don't count on it. Because, my default is probably going to be no report, no video, that sort of thing. But anyway, upcoming week, we've got the Fed, we've got options expiring. We got, of course, a really bearish second half of September historically to deal with. But the market is showing tremendous resiliency and trying to make a breakout. One thing I will say, and this could happen while I'm gone, so be aware of it. If you see a move, say intra-week, maybe with the Fed announcement, that we get a pop and we do go to all-time highs, and then say by the end of the week, we've come all the way back down, so that on the S&P 500, let me pull this up. Let's go to a weekly chart. So, I mean, if you're looking at this and you see this top on the S&P 500, and then you see a tail, an intraday high next week that goes up above, say, 5,700, and then comes back down and we close below all of these weekly closes, that is going to signal to me that we might have a short-term top in and that a lot of bad stuff could happen from there. So just be careful on a false breakout or even a test of a possible breakout and then a fallback, because we could be rolling over. And if we start to roll over technically, knowing everything else that we know, I think that's when you really want to be cautious. So anyhow, that's it for me. I do appreciate everybody stopping by. Please like our videos. It'll help us in some of the algorithms and stuff on YouTube. So even if you're not a paying member of ours, which I encourage you to be, you can still help us by clicking that like button, subscribing to our channel. You're going to want to see, I don't know exactly when I'm going to be doing these weekend reports, but one way to know when a report is done is by subscribing and then turning on your notifications. That way, anytime you're in YouTube, it'll come up and it'll basically tell you that, hey, Earnings Beats just uploaded a video. And then you at least will be aware of when it comes out. Because in the future, I try to do it when I have time. So it might be Friday night. It might be Saturday morning. It might be Saturday night. It could be Sunday morning. I never know from week to week, honestly, when I'm going to be, doing it. I try to do it outside of personal things that I take care of on weekends. So anyway, make sure you subscribe. So hit that like button, subscribe. We'd really appreciate it. Have a great rest of your weekend. Enjoy next week. I'll be gone. So I'll be at an island. I need to go to an island. But it'll be fun. Looking forward to that, and looking forward to seeing everybody when I get back. Have a great next week, everybody, and see you the following weekend. Happy trading.